Hey there, by now many of you are likely familiar with Alibaba's 1+6+N organizational structure. As the transformation gradually takes effect, how to calculate the valuation of each subsidiary after splitting has become the most important topic. Among investors, there is a popular Wall Street-style market valuation called SOTP, sum of the parts, which calculates Alibaba's value as the sum of its e-commerce, cloud computing, overseas business, Cainiao logistics, Hema supermarket, and group, entertainment, and etc. When you put the numbers into the calculator, the conclusion is striking clear. The actual value of Alibaba, based on the sum of its parts, is far higher than its current market value, right? No matter its stock dividends, buybacks, or reasonable market pricing, are all to discover the value of the parent company. The split will drive Alibaba's ultimate market value upward. This is also the underlying logic of Alibaba's reorganizational structure. But is this really the case? Today, I will help you identify the flaws in this valuation method so you can make informed investment decisions and see the true value of Alibaba. I'm a stock analyst based in China, and I'm also trading stocks. My goal is giving the investors a different view to look at the Chinese concept stocks. If you don't want to miss the quality stock analyst videos, don't forget to follow my channel. Now, let's dive in it. In this naive calculation, the most core variable is the valuation of Alibaba Cloud. Why is that? Because its listing logic is different from the others. This is a very important point, and everyone must remember that the positioning of Alibaba Cloud has always been a technology company, not a business company. Performance growth is not its ultimate goal. According to Alibaba's latest financial report, as of the quarter ending March 31, 2023, the revenue of the Alibaba Cloud business segment was 80.58 billion RMB, a year-on-year decrease of 2% after offsetting the impact of cross-departmental transactions, making the slowest quarterly growth since 2020. This is the first negative growth. In addition, an IDC report shows that in the second half of 2022, although Alibaba Cloud still ranked first in the Chinese public cloud infrastructure as a service plus platform as a service market, its market share has fallen from 36.7% to 31.9%. It appears that Alibaba Cloud is facing the dilemma of declining revenue growth and market share, so its listing is not based on the high growth. Returning to the question we raised at the beginning, how to calculate the valuation of Alibaba after split is not so simple. After cutting losses on Alibaba, Charlie Munger said that
one of the worst mistakes I ever made in thinking about Alibaba, I got charmed with the idea of their position on the Chinese internet. I didn't stop to realize they're still a goddamn retailer. It's going to be a competitive business, the internet. It's not going to be a cakewalk for everybody.
Can we understand from some perspective how Munger views Alibaba's overall value? We roughly understand the crux of the problem, and the most difficult part to analyze in the Alibaba group is probably the Alibaba Cloud. Therefore, in the order of the spin-off and listing, Hema and Cainiao are leading the way. After spin-off, Alibaba Group will no longer hold Alibaba Cloud stocks, and the split will be achieved by distributing dividends to shareholders. Tencent has also used the same method to distribute Meituan stocks, which is a good way to ensure the shareholders' returns. So, how much should Alibaba be valued after the split? From a positive perspective, considering that Alibaba Cloud's market share in China's cloud computing market was 31.9% in the last year, in the eyes of many investors, Alibaba Cloud is the only cloud computing company that can compete globally with Amazon Web Service and Microsoft Azure. A valuation of 8 to 10 times price-sales ratio is not unreasonable. Alibaba's revenue of 77.2 billion RMB corresponds to a market value of 800 billion RMB. From a negative perspective, unlike Microsoft and Amazon, Alibaba Cloud's profitability is limited by the fierce competition in the Chinese market. Investors who are not optimistic about Alibaba Cloud believe that its valuation should be no more than 3 to 5 times price-sales ratio. If you want to know the more details about how to give a reasonable value to Ali Cloud, you can turn to my Thinking Alpha articles. Or you want to get more high-quality analysis, you can through Thinking Alpha's link below my video. Why is Alibaba Cloud underperforming? By 2030, according to industry experts estimating, cloud computing spending will increase to at least 3 to 6 trillion RMB, while China's cloud computing market was only 177 billion RMB in 2020, representing a high growth pace of 20 to 30 times. In addition to the huge market prospects, cloud computing also constitutes a very good business. Microsoft and Amazon's cloud computing operating profit margins are close to 40%. As an industry leader, Alibaba Cloud is expected to eventually grow into a super giant. However, since 2021, Alibaba Cloud's high growth has been declining. The reason for Alibaba Group's growth slowdown is not difficult to understand. As of the end of 2021, the internet industry accounted for 48% of Alibaba Cloud's customer revenue. Context to the sluggish internet economy, Alibaba Cloud has also experienced growing pains, and the pressure of the economic cycle has also been transmitted to the cloud computing leader. In addition, the special nature of the domestic market is also closely related. It is well known that one of the major costs of cloud business is IDC cost. Domestic cloud vendors need to pay huge bandwidth usage fees to the operators every year. Overseas cloud vendors can build their own networks, and the burden of IDC costs is smaller than in China. Traditional cloud computing service providers were originally supposed to be big landlords who rented out zero marginal cost computer power. But in reality, the unavoidable bandwidth usage fee has turned most cloud computing service providers into second landlord who work for bandwidth usage fees. It is clear that compared with companies such as Amazon and Google, Alibaba Cloud's business model has inherent flaws. And under the same conditions, it cannot become a benchmark overseas company with a 40% operating profit margin. Therefore, in the aforementioned valuation method of Alibaba Cloud, there are obvious logic loopholes in both the ceiling and the floor. More importantly, in addition to the cost structure, the product from the structure of China's cloud computing is also far from that of foreign countries. Before 2019, China's cloud market was dominated by private clouds, and public cloud business has improved, but private clouds still account for 43%. It's not difficult to infer that the higher the proportion of private clouds, the higher the cost of customized development, and the higher the time and the cost of customer acquisition and execution. We can conclude that as the economy stabilizes, cyclical factors that plague Alibaba Cloud may not be a problem in the future, but the underlying logic of the business model, which cannot be solved. In May of this year, Alibaba Group Chairman Zhang Yong personally led Alibaba Group Intelligence. Of course, updated news that Zhang Yong will resign from the position of the CEO. Fierce price war quickly started, with Alibaba Cloud's core product price lowered by 15% to 50%, and shorted product prices reduced by up to 50%. However, can this price war kill Alibaba Cloud's anxiety? In the era of booming cash cows in e-commerce, such drag is not particularly noticeable. However, in today's increasingly competitive e-commerce business, the reason why Zhang Yong personally takes action is self-evident. In fact, not only Alibaba Cloud, but also the other 1+, 6+, and business models faces the same problem. If you want to invest in China, subscribe my channel and get a latest perspective of the equity research.